I don't want to over-tighten. That's a direct statement from Fed Chair Jerome Powell just a few weeks ago when talking about hiking the Fed funds rate. So is the Fed starting to change their stance on the 2023 reset? Well, in today's video, we're going to talk about that in more detail. We're going to look at some statements that Fed Chair Jerome Powell said back in early November, and then we're going to take a look at some statements that he made in early December, just 1 month later, and how much his stance is changing. Now, I do believe his stance is changing, and it's primarily because the Fed is starting to see some cracks in the economy. Even though payrolls grew by 261,000 in October, we're seeing jobless claims hit a new 10-month high, and this is coming on the back of the Fed warning that there's a 50% chance that we're going to see a recession. Now, we all know the Fed reset has had an impact with regards to house prices, as we saw October house price growth slow to half of the highs that we saw in early spring. We're actually going to take a look at that decline in a little bit more detail, at the home price changes in America's biggest cities. We're going to look at those declines. We're going to look at what some experts are saying about the continuation of those declines, in addition to taking a look at housing market forecasts for 2023. Now, as we take a look at the changes in the Fed statements from just 1 month ago, I'd like to take a minute and ask that you smash that like button. Now that you've done that, let's take a look at the direct commentary from Fed Chair Jerome Powell just 1 month ago. So in early November, Fed Chair Jerome Powell made two critical comments. There is significant uncertainty around the endpoint of rate hikes, which he indicated by stating we have some ways to go. Furthermore, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive. And then he went on to say if we over-tighten, we can support economic activity. So those statements were pretty hawkish. It looked like the Fed was going to do whatever it took to get inflation down, regardless of how it impacted the economy. And just 1 month later, Powell backtracked on some of the comments he made, and this is what he said. The time for moderating hike pace may come as soon as December. In addition to this statement, which I think is the most important, where he says, I don't want to over-tighten. Cutting rates is not something we want to do, so that's why we're slowing down, and we will try to find our way to what that right level is. So you can see in just 1 month, the Fed kind of backed off, or at least Powell backed off that really aggressive stance with, hey, we're going to continue to hike the Fed funds rate at whatever cost. In fact, Jerome Powell has indicated that robust consumer demand, a tight labor market, and more persistent price pressures could compel officials to lift rates next year to slightly higher levels than they had projected back in September. And back then, most had estimated that the Fed funds rate would increase to 4.5 to 5 early next year. So based on that statement, it sounded again like the Fed was going to get aggressive, but the most recent statement shows a hawkish stance where the Fed is starting to get a little bit more concerned, likely due to many warning signs going across the economy. At the moment, there's a 77% chance that the Fed is going to hike the rate 50 basis points come Wednesday, December 14th. In fact, 41% of interest rate traders are expecting another 0.25% hike in February, where another 48% are expecting at least 50 basis points at that time. So at the end of the day, the expectations are all over the place. But come Wednesday, I think you're going to get a lot better idea of what the Fed is going to do as we move into 2023. For those of you who have been living under a rock for the last couple of months, the Fed actually meets this coming Wednesday, where they will have seen the latest CPI data that comes out the day before. And if the numbers report like I think they're going to report, you're likely to see inflation go down. Now, I've said this in videos before, but I think it's important to note that we're not going to see inflation at their 2% target. In fact, we're a long ways from that, but we are likely to see inflation year-over-year decline, which would send the inflation numbers lower and show the Fed that what they're doing is actually working. But here's the caveat. If the inflation numbers actually come in higher than expected, well, you could see the Fed remain aggressive and continue to hike the Fed funds rate. And if the PPI is any indication of what we're expecting, then again, you're likely to see those inflation numbers go down. Even though the PPI numbers were higher than expectations, they actually eased in October, showing that inflation is actually moderating. The producer price index, which generally reflects supply conditions in the economy, climbed 8% in October compared with the same month a year ago. Though prices continued to rise rapidly, the pace marked an easing from September's revised 8.4 increase and was down sharply from the 11.7 increase in March, the highest since records began in 2010. So with that, I do believe inflation is going to continue moderating, giving the Fed an opportunity to take their foot off the gas pedal. But at the end of the day, do you really care what the Fed is doing? You really care about how it impacts you if you're looking to buy or sell a home. What's it going to do to home prices? Is it going to continue to bring home prices down? Or on the other hand, by the Fed slowing down, is that going to provide some stability in the housing market? And honestly, that's the real question at hand. Now, while many of you know I'm super bullish on housing long term, I do want to take a look at some of America's biggest housing markets and look at the declines that we've seen from the peaks back in the spring, and also take a look at what some of the experts are saying about what we're likely to see in 2023. So as you can see here, San Francisco is down 12.3% from the peak, Los Angeles down 7.2%, Seattle 10.9%. But then you start looking, in the South, Houston only down 1%, Miami down 1.5%. And this chart is actually coming from the American Enterprise Institute, their housing center, and Ed Pinto is actually their director there. And now Ed Pinto is a very smart dude, somebody that I trust, somebody that I read, but his statements here are super bearish, and I don't necessarily agree with what he's saying, but to provide complete transparency, I want to read it. Pinto predicts that we'll see a continuation of the present trajectory through the end of 2023. The West Coast markets will keep dropping rapidly, and the still relatively affordable Sun Belt metros will suffer relatively small declines from their record highs. In markets such as San Jose, San Francisco, and Seattle, you could see a total decline from the spring peaks of 30%, says Pinto. Now, I don't agree with that at all. I think 30% is way too high. That means another 15% or more from the decreases they've experienced through October. On the other hand, he believes that the combination of continued strong population growth and affordable prices sustained by strong levels of new construction versus the West Coast markets will keep future total declines in the mid-single digits. I see decreases of maybe 5 to 7% in markets such as Northport, Orlando, and many affordable Sunbelt markets. So the big reason he's expecting these declines is because of housing affordability. And many of you know that housing affordability is at its worst level on record, with many other experts actually out there expecting a 20% decline. But he goes on to talk about the tale of three different markets. He says we're witnessing a tale of three markets: the overpriced, extremely vulnerable West Coast from where people are fleeing, the Sun Belts that's boomed but whose affordability provides good protection, and the Midwest and Northeast that didn't really join the joyride, but whose fortunes will closely track the trend in employment. I expect that the immense variability we've seen from region to region to continue, Pinto concludes. So basically what he's saying is that he expects the West Coast to continue to decline lower. He's expecting the Sun Belt areas to remain pretty stable, and the Midwest, those areas that didn't really see the appreciation that, say, California saw, well, those markets are likely to remain pretty stable as well, unless you see something major happen in the economy. If you see a major recession, if you see a lot of job losses, then you might see further declines in those markets. So while I don't necessarily believe with his numbers, even though I do trust a lot of what he says, I think it's super important to make sure that you're buying for the right reasons. As we talk about often, you have that longer term time horizon, you have money in the bank, you're not stretching yourself. But if you are one of those people who has purchased earlier this year and you've seen your home go underwater, should you be stressing? I say no. Unless you have to sell your house, you shouldn't worry about the value of that property. You should just worry about continuing to make that payment and living your life. Now, as promised earlier in the video, I wanted to also take a look at some housing market forecasts for 2023 from places like CoreLogic, Goldman Sachs, Zillow, and Redfin. So as you can see from this chart here, expectations are all over the place. In fact, there's only a few that are actually expecting some positive appreciation. CoreLogic at 4.1%, Realtor.com at 5.4%, Zillow at basically a 1% increase, National Association of Realtors at 1.2%, and the Mortgage Bankers Association at 0.7%. And on top of that, you got Fannie Mae expecting a 1.5% decline. You got Goldman Sachs expecting anywhere between 5 and 10%. You have John Burns Burns Real Estate Consulting expecting a 20 to 22% decline. You've got Redfin expecting a 4% decline. And lastly, Zonda expecting a 10% decline. With all of that said, mortgage rates are going to be the biggest indicator with regards to the direction of housing. And if you want to know my thoughts on that, do me a favor and check out this video here.